All right. Again, this is not financial advice. This is my own personal opinion. Do your own research. But as many of you know, if you've been following the trend lately, these synthetic covered call ETFs, these high yielding ETFs, they have been a yield trap, meaning that your NAV goes down, and it might go down slowly at first for some of these stocks or some of these ETFs because the underlier is going up, but it's not going up strong enough to compensate for the now weekly distribution. Like just last year, there was, they were usually, before any of this stuff hit the market, there was only quarterly distributions from big name companies like Coca-Cola, Pepsi, Home Depot, whatever. Now we're into monthly distributions, which makes more sense if you think about it. But I'm going to explain to you why there's just, the more you analyze this and you start looking at this and you learn exactly what they're doing, how they're trading the synthetic covered call strategy, and how they give you a distribution every single week, whether the stock is up or down or not, is really the big problem. So, and this is why ultimately I have stopped putting my money into these things, because if I were to buy a stock, say I was to buy 100 shares of MSTR, okay, like, everybody used to love MSTY because it was doing amazing, but that's because MSTR was doing amazing. See, I'm looking at the chart on MSTY right now. Let's go to MSTR and look at the chart 1 year ago. Yeah, right here, even after the tariff dip here, we rallied up and it got up into the 400s. So MSTY was doing really good. But here's the problem. They were still paying you a distribution when MSTR was crashing down here. Now it's sitting at 161. So that right there is unsustainable. And not only are you in single stock risk, so you have no diversification, but everybody was banking on, well, MSTR is buying a bunch of Bitcoin. It's for the long term. It's a good thing. And it's not. It really isn't. Now, if you were to hold MSTR, say you were to hold it here, long term, you might be okay even way up here at the top if this thing turns and goes to 4,000. So, yeah, you would be looking like a genius even if you just held on to it. But MSTY has already I think it did a 4-to-1, or I think it was a 4-to-1 reverse split not too long ago. And so you just lost 1/4 of your shares. And then if it still goes down, now you're just losing even more money, and yet they're still giving you money back. Now, everybody says, well, if you reinvest. Okay, well, if you're reinvesting, why are you even doing these ETFs? These are not meant to be reinvested, even though Jay from YieldMax has said, you should be reinvesting some of this. You shouldn't have to. So if I'm going to look at this for retirement, like a lot of people were like, oh, this would be a great retirement tool. I could put a bunch of my money into these things and live off the distributions. Actually, you can't. And because of the NAV erosion is so bad on these, because when the NAV goes down, your distributions go down. Otherwise, they would go to zero. They'd have to constantly reverse split. And if you don't keep putting more money into them, you're not going to have anything left once you reverse split it. Now your shares have been cut in quarter. 4 shares went to 1 share, and now your distributions are less. You'd be like, getting 5 cents a week or whatever. It wouldn't even matter. So I say all that to say this. Let's look at a total return, and this is a really fun website to play around with, totalrealreturns.com, and it actually takes in reinvesting all your dividends. So those of you that think that you're growing an account by that compounding, you're actually just putting your money into something that's slowly declining. Because here's the big thing. If you're going to sell a covered call, if you're going to run the wheel strategy, for example, now they're not doing wheel strategy, they're just selling covered calls. They're buying a long call position and then either selling puts or selling calls also against that, is how the covered, the synthetic part of it is the long call. So they're buying a call option, a leap option, more than a year out or whatever, and then they can sell calls against that, so they don't actually have to own the shares. So it doesn't matter if it's a synthetic or not, it still works kind of the same way. You would buy, here's MSTY. This is back if you were to put $10,000 in on May May 8th of 2025, you would have $4,400. You'd actually be doing a little bit better than MSTR, which you would have lost money. That's if you reinvested everything. But why bother? You're still losing almost $6,000. Hood, on the other hand, Robinhood stock, you'd be up 22, you'd double your money in just putting it in Robinhood stock. And if you were to, reinvested all your dividends from Hui, from YieldMax, you would have only $17,000. Now that's $7,000 gain just from last May. But again, you're still down if you would have just invested Robinhood. Now, here's what I'm going to say. And again, this is not financial advice. Do your own research. Think about where you are in your life, in your portfolio, value, all that stuff. But the realization that I come to is you have no control over when to sell covered calls. And if you were to sell covered calls every single week like they're doing, that's not always the best time. You're going to get assigned. And if you get assigned when you don't actually own the shares, then you have to sell that long call position or roll it, in this case is what they do. And so even though you're getting a distribution, for the first, you put $10,000 in, your first $10,000 is ROI, return of capital. And a lot of times these are just return of capital because they have to take money out of the NAV to pay you because everybody wanted high yields. So something that I've looked into and I've considered doing is when I get to retirement, I'm using actual growth stocks, ETFs, good solid ETFs like SPY, QQQ. Here's a QQQI. Look at the 5-year turn. It's up 9%. So you want your NAV to be sideways to up and without any dip. And again, I don't use leverage. You can, I'm not telling you what to do, but I don't use leverage because it's, even in a bull market, you can get crushed on leverage because there are dips in bull markets, by the way. So depending on how much leverage you are, but use your own money. And look at this. You would be up 9%. Now here's where everybody's going to be like 13%. That's not that much. Well, no. If you're playing with only a couple $1,000, you're not, what's the point? You might as well get into a growth stock, build that up. If you put $500,000 into this thing, you're going to get $6,400 a month. What's the stock price? Let's just say $500,000 divided by, let's say you bought it at $55. That's going to give you 9,000 shares times, what was the last distribution? 0.64 cents. That's going to give you $5,700 a month off $500,000 in this. And that you can take and use it all because your NAV is not eroding. If you were to do that with MSTY, where is it? Here's MSTY. You would have to reinvest because now this is accounting for the reverse split. So what would this price be? 145 divided by 4, I believe. Yeah, $36 or something right here. Went down to 10. If they didn't reverse split, 25 divided by 4, MSTY would be at $7.56 right now. That's really what it is. They reverse split because they had to. I think, it would have gone to 0 eventually. And it will. They'll have to reverse split this again. So you're basically, if MSTR turns and starts running, it has to do it soon for this to make sense because this is probably not the bottom. Again, they're paying out dividends. Whoops. Where'd it go? Here we go. Of 40 cents a week. Look at this, 285 cents yield. That is not sustainable. I know I don't even know if that's from last week, but let's just say a month, okay? If it did 0.40 times 4, $1.60 off a NAV that's only $30. You're just not going to be able to maintain that, especially when MSTR is falling the way it is. And that's the thing. Right now, if you owned MSTR stock, depending on when you bought it, would you be selling covered calls right now? Usually you want to sell covered calls after a big run up so you're at less risk of getting assigned, right? If you're selling covered calls when it's about to run up, you're going to get a sign and you're going to lose all that upside, which is exactly what covered calls do. They cap your upside, because if we were to sell a covered call here a week out at 170 and MSTR runs to 180, which it could very easily do. I mean, I'm not saying it's going to go to 4,000 anytime soon, but if it can blow past 170 like in the next couple hours here, if it really wanted to, you're going to cap all that upside. You're going to lose that. Yes, you got the premium, but you lost all that upside. That's why, for retirement purposes, build up your nest egg, by going and investing in, things that are actually growing, and be diversified. We can get into other things that I will talk about in other videos on how to look at the charts and play the game to where you can really magnify your gains by investing in the entire market using leveraged funds. But again, you got to know how to play those too, so we'll get into that. But that's the reason. That's a real big reason, because I wanted to grow my portfolio. And just covered call funds do not grow your portfolio. They basically, some have a smaller hole in the bucket and some have a big hole in the bucket. And the ones that have a small hole, it's kind of hard to tell when that water is, if it's going down. If you put a pinhole in a bucket, especially if it's a 5-gallon bucket and it's full of water, you might not notice that water, and that is, an analogy for your NAV is the water in the bucket. And, you could take and scoop out some and use that. But eventually that leak is going to drain the bucket until you put more water back into it. So I hope that made sense. I hope that if you're really trying to grow a portfolio, I highly recommend, again, this is my own personal opinion, do not take my advice. Do your own research on these things. They're momentum plays. So if you want to grab some premium, make sure that the stock is moving upward. Again, MSTY, now that MSTR looks like it could potentially be a buy. This is the daily chart. It looks like we're starting to turn the corner. But again, it might not. MSTR could still go down below 100. And what's that going to do for MSTY? They're going to keep paying out weekly distributions. And that NAV is going to keep going down, because you got to you actually have to have enough momentum to offset that weekly distribution, right? So if you were just solely looking at this as a growth stock, just think about this. Every week it's going to go down, regardless. That's just a fact. It's going to go down by the amount of the distribution every week. So that growth has to be higher than that distribution, and then you'll get some upside. Otherwise, you're losing money. It's that simple. So I hope this helped you. I hope your portfolio is going to be growing in 2026. Be smart. Don't chase the highest yield. You will get burned. Don't lose any more money in 2026. Thank you for watching. Have a good one.